Okay, Matt Bumstead here with Multop Financial and Dan Perrino, also with Multop Financial and Clarity Capital Management. We're doing another short video right before the Thanksgiving holiday. So happy Thanksgiving to everyone out there. I hope everyone can recognize what they're thankful for and give thanks for that this holiday. We wanted to discuss briefly with everyone about year-end tax planning and year-end financial planning and investment planning. Coming up this next month is a really crucial time to be doing some tax loss harvesting for your various non-qualified accounts, your non-IRA accounts. This year has been obviously a very interesting year in the market, 2020. We've had some stocks that have done incredibly well, especially in the IT sectors. We've also had some stocks that have done pretty poorly, for example, in the energy sector. And it might be a great opportunity if you have some of each of those in your portfolio or funds that have not performed well, to be able to capture those losses and then offset some of those gains by capturing the gains as well. If that's not done by the end of the year, all you're going to end up doing is paying capital gains on the ones that have gains. So if we can capture some of those losses in the meantime, that might be a really good tax opportunity to minimize your taxes. So come talk to us about that if that is of interest to you. And Dan also has some things to discuss as far as 401ks and Roth IRAs and IRAs to mention.
Okay, awesome. Thanks, Matt. Yeah, so as we approach the end of the year this year, December 31st marks an important deadline. For those of you that contribute to your 401k, you're going to want to make sure that you're maxing out your contributions to help offset your taxable income. So if you're under the age of 50, you can contribute up to $19,500, and if you're over the age of 50, you can contribute up to $26,000 this year. So if you're close, but you're not quite there yet or on track to max out those contributions, I suggest talking with your HR professionals with your company and figuring out how to adjust your contributions through payroll deductions through the end of the year to meet those maxes and help reduce your taxes. Now, if you're in a fortunate position where you're able to contribute more than that $19,500 or $26,000, if you're over the age of 50, your 401k may allow for after-tax contributions. This is a really cool functionality that will allow you to get more money into retirement accounts, but specifically more money into a Roth IRA retirement account. Now, for those of you that are high earners and are not eligible to contribute to a Roth IRA outside of your 401k, this is a very, very key and important part of your retirement plan if you have this ability. So whenever you make after-tax contributions to a 401k, in order for this to happen, you first have to reach the contribution limit, and then any contributions past the contribution limit will be after tax. You will pay taxes on them, but they will go into a tax-deferred retirement account. The important part about that is any after-tax contributions that you make, the principal of those contributions is eligible to be rolled to a Roth IRA. So this is a great backdoor way to get some funds into a Roth IRA, which is one of the most tax-advantaged retirement accounts. It is the most tax-advantaged retirement account out there, and they add awesome flexibility in retirement in terms of adding an additional source you can take tax-free income from. So that's one important thing to keep in mind. Make sure you're maxing out your 401k contributions through the end of the year. If you don't have the income to do that, at least make sure you're contributing an amount to capture the full match from the employer. So every plan is different. So if you have any questions, Matt and I are here to help you navigate those and figure out the details. Additionally, if you just contribute to a traditional IRA or you have a SEP IRA, your deadline for the 2020 contributions and reaching that limit is when you file your taxes in the spring or April 15th, whatever comes first. So Matt and I are here. We're resources for you. Please give us a call. And, we love working through these sort of issues and figuring out how to get more money into your retirement accounts, but also reduce your taxes. So give us a call with any questions.
Yeah, and also one last thing to add, this may have been one of those years where you didn't make as much income this year as you have in previous years due to layoffs or something like that. People have a lot of questions surrounding the CARES Act and drawing money out of their 401k or their IRAs this year to avoid the penalty. All of that's still taxable money, though, for the most part. And we have tax professionals here at Multop Financial and Clarity Tax Management that can help you kind of navigate how much taxes you're going to be paying. So if you're not currently a client of ours, please don't hesitate to come in and to talk to us about that, or call us to talk to us about that. We're doing a lot of virtual meetings right now. And in addition, it might be a good opportunity to convert an IRA to a Roth IRA this year also. If your taxes aren't going to be as high, great, take advantage of that, and let's convert some while we can over to a Roth IRA. That way, when you go to retire someday in the future, that money will never be taxed again, even the growth, which is fantastic. All right. Well, happy Thanksgiving to everyone. Thank you, Dan. And hopefully we'll be talking to you soon.